Creativity is a social experience. You're not creative alone.
Despite its struggles, ESG can overcome the criticism and help make companies more accountable towards all stakeholders.
Today we're going to talk about things like trust and teams,
Bitcoin, blockchain, cryptocurrencies.
Hello and welcome to this 10th RESKILL Masterclass. I'm the head of research communication. My name is Daniel Brown. And today it's our great pleasure to welcome Thierry Foucault, who is one of the most experienced professors in HEC's finance department. Thierry, it's really a pleasure to welcome you to this RESKILL Masterclass, where you're going to answer the question, could AI trigger the next financial crisis? A very topical subject, I believe. And after that, after your 20-minute presentation, you'll be answering questions that will be sent in by you, the viewers, and we welcome you from all over the world. Thierry, the floor is yours.
Thank you, Daniel, and welcome everybody. So I'm Thierry Foucault. I am Professor of Finance at HEC since 1998. And before I start, discussing the question for today, let me first explain how I got interested in this question. A large part of my research is about the effect of information on financial markets. And as I'm going to discuss, artificial intelligence is a technology to produce information. So it was natural for me to start thinking about the impact of artificial intelligence on financial markets. The second reason is that in 2020 until 2022, I became the scientific director of iParis. iParis is the joint center between HEC Paris and Institut Polytechnique de Paris on artificial intelligence. And one of the goals of the center is to develop research on the impact of AI on society. And so this collaboration with the Institut Polytechnique de Paris stimulated as well very much my interest into this topic. The last reason is that 2 years ago, I got a grant from the EU, a so-called ERC grant, to work on the effect of AI and big data on financial markets. And my talk today is going to be based on the findings of this research, essentially. So let me move to the question now. The question is coming from this guy. So for those of you who don't know him, he's Gary Gensler. So Gary Gensler is, not for long anymore, is the current chairman of the SEC, the watchdog of US security markets. And in many reports and interviews in Financial Times, for instance, he has expressed the concern that maybe the next financial crisis is going to be due to the fact that increasingly in financial markets, people are using tools from artificial intelligence. I think we should take this guy seriously for at least two reasons. First of all, he's the chairman of the SEC. The second reason is that he has been lecturing about AI at MIT, for instance, and he has written very interesting papers about the potential of AI for financial markets, but the risk as well. Well, among the people attending the class today, 66% think that, yes, AI is going to be the cause of the next financial crisis, and 44% think that this is not going to be the case. So there is there are divided opinions about that. I'm going to step back a little bit. I'm not going to give you my own view on this question. I think, to start thinking about whether AI could trigger the next financial crisis, we need to think a little bit more about what artificial intelligence has to do with financial market in the first place. Why this technology is so important for finance. And I'm going to spend time on that and give some examples of implications based on my own research. So you can think of artificial intelligence as a technology. This is a technology to extract information from very vast amount of data and transform this information into predictions and decisions. So in the context of financial market, this means prediction about stock returns, for instance, predictions about corporate earnings. So very often people compare the big data to oil. Oil is a raw material, big data is a raw material, and you need a technology to transform that into something that can be useful for decision making, for instance. That's exactly the same thing with artificial intelligence. That's a set of algorithms, machine learning algorithms, techniques to mine a very large amount of data and extract predictions about the future from this data. Why is this important for finance? Because a core function of the financial industry is to produce information. If you think about it, for instance, think about security analysts. The role of a security analyst is to use financial statements, or at least this was the old way to do that, use financial statements, balance sheet information to forecast future corporate earnings, make predictions about where the stock price of a firm is going to go, and so on and so forth. That's a prediction problem. Let me take another example. Think about credit rating agency. They have, to give a grade that reflects the credit risk of a firm. This grade is based on a prediction about the default risk of the firm. That's a prediction exercise. Think about a bank that has to decide whether to make a loan or not to a borrower. Then part of the exercise is to assess the default risk of the borrower. That's again a prediction exercise. And I could go on and on like that to convince you that basically finance, the financial industry, many occupations have to do with predictions, have to do with forecasting. So given that, it's not very surprising that artificial intelligence is having a big impact on the industry. That's a technology that is going to change the way people make forecasts and prediction about the future in finance. So traditionally, as I was mentioning, let's think about security analysts, for instance. Traditionally, security analysts have been relying on financial statements and expertise to make forecasts, corporate earnings forecasts. Increasingly, they are relying on alternative data. We know because they mentioned the use of so-called alternative data in their reports. Alternative data, this is very different from financial statements. This is not data controlled by firms, if you wish. These are not disclosures of firms. There are many different types of alternative data. This can be, for instance, messages posted on social media. This can be satellite images. That can be as well transcripts of earnings calls, for instance, when managers discuss, the future of their firm with equity analysts, and so on and so forth. So there is a huge amount of alternative data that is produced every day. Every digital footprint that we leave, on the internet is a piece of data potentially. And those data, they are collected by specialized firms, vendors, who are going to collect the data and who are going to clean the data, process the data to some extent, and resell the data in a refined way, a bit like a refinery for oil, if you wish, to the financial industry. So the graph on the right-hand chart of the slide is showing an estimate of the number of firms specializing in selling alternative data to the financial industry since 1996. So you see there is an exponential growth in this number. And a few days ago, I was checking the website of a broker of alternative data, which is called DataRed. And DataRed in its catalog has more than, I think, 2,000 data vendors and more than 20,000 data sets. And those data sets are huge. So one question is whether, of course, there is information in those alternative data. That's a lot of data. It's very, very noisy. But can you use this type of data to predict corporate earnings, for instance, or stock returns? The answer is yes. There are many academic studies on this topic, and they find that, yes, you can use this type of data for predicting corporate earnings, for instance. But what they find as well is that the nature of information in this data is very short-term. That is, you have good predictive power for, let's say, next quarter earnings, next year earnings, but not much beyond that. Not much beyond that. So one interesting question is whether this is affecting the ability, for instance, of security analysts who rely on this type of data, among other things, to forecast the long term. So this is what we did with colleagues at INSEAD, Olivier Dessin, and the University of Lugano, Laurent Frézard, in a recent paper that we published in the Journal of Finance. So what we do in this paper is the following. We collect analyst forecasts, equity analyst forecasts over the very long run, since the 80s up to 2018. And we compute, we measure the quality of their forecast. It's very simple. What we do is that we compare the realization of earnings and we compare it to the prediction, analyst predictions. If the gap is large, the forecast is of poor quality. If the gap is small, the forecast is of good quality. What we find, we have a very large sample, we have millions of data points. Huh? What we find is that over the long run, analysts have become better at forecasting the short term, but they have become worse at forecasting the long term. And what we find is that this is especially true in industries that are well covered by alternative data. We know because analysts mention the use of alternative data in their report. So we can really measure the extent to which they rely on the data. So from there, we formulated the hypothesis that maybe the degradation of their forecasting quality for the long term comes from the fact that alternative data is very good for the short term, but not the long term. And in a sense, it is pushing the attention of analysts from the long term to the short term. So correlation is not causation, so we spent a long time in the paper trying to establish the causal link in our hypothesis. I'm not going to enter into the nitty-gritty details of the study, but we use, alternative data from a platform, a social media in the US, which is called Stock Tweets, and we show that indeed, when a stock is discussed a lot on Stock Tweets, that produces a lot of alternative data, if you wish, then analysts following the stocks, they become better at predicting the short term, but worse at predicting the long term. So first risk with artificial intelligence, it's not a market crash, but it's maybe pushing people attention, forecasters' attention, to the short term rather than the long term, which is not very good. If you think about what financial markets are supposed to do, there is this concern that maybe financial markets are too short-termist. Well, maybe alternative data is going to reinforce this trend. Let me move to a second concern. There are big discussions at the moment about the effect of artificial intelligence on the future of jobs. There is the concern that machines are going to replace humans. That's true as well in the financial industry. The guy that you see on the slide here is Larry Fink. Larry Fink is the CEO of BlackRock. BlackRock is a big asset manager. And this picture is taken from a New York Times article, which explains that BlackRock is replacing its traditional asset managers, fund managers, humans, trained in the old way, if you wish, stock pickers. BlackRock is replacing traditional stock pickers by quants. Quants are people who are skilled in processing very large amounts of data with tools from artificial intelligence. They have been trained to use data science. Quant funds rely on research teams, data scientists that crunch very vast amount of data to form their prediction. So one question is whether the arrival of quants is displacing traditional fund managers. Maybe traditional fund managers who rely on more traditional expertise, they are going to be specialized by industry, for instance. They have unique abilities to predict the future that cannot be easily replaced by machines. So that's the question we ask in another study with Maxime Bonelli. Maxime Bonelli used to be a PhD student at HEC Paris. He's now a professor of finance at the London Business School. And so what we do with Maxime to address the former question is the following. We get data from a satellite images data provider, which is based in the US, which is called RSmetrics. And one of the products sold by RSmetrics is very simple. RSmetrics is taking every day with satellite pictures of parking lots of retailers in the US. It counts the number of cars on those parking lots, and with this information that is sold to you or to fund managers by RSmetrics, you can derive a measure of the utilization rate of a parking lot on a given day. And here, this is not, skyrocket science. If you have this information, well, you can probably forecast next quarter sales for the retailer. So this is just one example of a type of alternative data. And we know from discussions with RSmetrics that this type of information, this type of data, is bought by quant fund managers. So coverage of retailers by RSmetrics has been gradual. It began in 2009. Walmart, for instance, is covered starting in 2011. And it goes until 2018 in our sample. And in our sample, we have about 48 retailers that end up being covered by RSmetrics. And we ask the following question. When RSmetrics initiates coverage of a particular retailer, Walmart, let's say, is it good news for fund managers or bad news for active fund managers? The guys, you know, who are supposed to try to collect information, make good forecasts about the future, and make portfolio choices based on this information, the stock pickers. Well, the answer is no. What we find is that we use a very large data set about the portfolios of US fund managers, active fund managers, and we find that when they have a retailer stock in their sample, and this retailer began being covered by RS metrics, then the average performance of an average fund in our sample in this stock is going to go down. And we show that this effect is stronger for fund managers who we suspect derive information in the old way, that is using expertise, for instance, industry expertise. While we show that fund managers that seems to be more quants, we don't know exactly with our data, they are not affected in the same way. So second risk here. Second risk is that if people lack the skill to process vast amount of data, you know, or the skill to understand what data science is about, artificial intelligence is about in finance, well, they may be displaced. They may have to move to another occupation. That's one of the reasons why at HEC, for instance, we are increasingly, you know, blending our courses in finance with courses on data science. This is because we think, you know, data science is going to have a major impact on the financial industry. Now, let me move to a third risk. So I have been talking about equity analysts. I have been talking about fund managers. Let me talk about traders now. People who execute orders in financial markets. You have brokers, for instance, who execute orders from the fund managers I was talking about previously. But you have also market makers, for instance, people who are posting quotes in the market. Trading firms like Goldman Sachs, for instance. Well, humans in those firms, they are increasingly replaced by algorithm, machines. This is not a new evolution. Algorithmic trading in financial markets began about 20 years ago, even more than that. What is new, maybe, is the way the algorithms operate, if you wish. That is, so far, algorithms have essentially replicated tasks that were performed by humans following the rules that humans were following. But you can imagine another type of algorithm which learn by itself how to behave in the market. A good analogy is AlphaGo. Probably some of you have heard about AlphaGo. AlphaGo has been developed by DeepMind, and AlphaGo is based, you know, on reinforcement learning. That's one particular tool of artificial intelligence. And AlphaGo has become extremely good. It has learned how to play the game of Go by itself. It has become so good that it has beaten the world champion in this game. So can we, maybe we are going to see the same evolution in financial markets. Maybe this is going to create a new type of risk. One potential concern is that this may destabilize financial markets. The graph on the bottom right-hand side of the slide here is showing you the evolution of stock prices in the US on the day of the flash crash on May 6, 2010. The flash crash, you know, happened on a very short interval of time, about 30 minutes, and there were investigations about the cause of the flash crash, and it seems that this was due in part to the malfunctioning of one algorithm. But in this case, this is not really the algorithm that was the reason. That was the coder of the algorithm. The algorithm had not been coded in the right way. So the human was still present. But maybe we could envision situations where, precisely because algorithms learn in a way which is very black box, learn how to behave in a way which is very black box, we may end up in dangerous situation, and without being able to know exactly what is the origin of the danger. Let me give you another example of that, based on my own research. So economists have observed that in online markets, there is a tendency for algorithm who set prices online to sustain non-competitive prices, maybe collusive prices. That is, prices that are not competitive enough for the consumer. So that's not very good news for the consumer. So with two of my colleagues at HEC, Stefano Lovo and Jean-Edouard Colliard, who have asked whether something like that could happen in financial market. The way we did that is by running experiments. So we created an artificial financial market, if you wish, in the lab, and we train algorithms like those guys using reinforcement learning principles, a tool of artificial intelligence, to post quotes like the guy on the left-hand side in our artificial financial market. And we found something, we found many things, there are many patterns that are interesting, but we found something which is similar to what economists found for online markets. That is, in our artificial market, our algorithm seem to learn how to set prices which are not completely competitive. They do not seem to learn a central tenet of economic theory, which is if you undercut your competitors, you are going to raise your profit because you raise your market share. And our algorithm, they do not seem to learn that well. That might be good news for the people, setting up those algorithms, not so good news for investors in financial markets. So let me conclude. Will AI trigger the next financial crisis? I don't know. I could say yes, I could say no. I don't know. Are there risks associated with AI? Yes. And some of those risks are not obvious. For instance, the risk that it may push people to push too much attention to the short term, being good at predicting the short term, maybe not good at predicting the long term. The risk that people may lack the skill to flourish in an industry that relies more and more on the tools of artificial intelligence. And the risk that algorithms, those guys, are not going to behave in the way we would like them to behave. Thanks a lot, and I'm happy to take your questions now.
Welcome back. So Thierry, thank you very much for an engrossing masterclass and really pragmatic and real situations. But a question actually came from Cédric in Montreal. He asked, could machines destabilize financial markets?
It could potentially. Again, over the last 10, 15 years, there have been many cases of very erratic price movement in financial markets over a very short period of time. I gave the example of the May 6, 2010 flash crash because that's one big event, in people's mind, and that triggered, the attention of regulators. But there have been smaller scale events like that repeated since 2010, and researchers have been trying, to study whether algorithms were involved or not. They are to some extent in some cases, but not always. So that they are in some cases in the sense that very often you have algorithms that misbehave because they were badly coded. So that's a form of operational risk when you are using an algorithm. I think another concern will be the one I was mentioning before, which is in a world in which algorithms are learning how to behave, their behavior is going to emerge, but their behavior is going to be black box. Explaining why they behave in the way they do can be very difficult. In fact, in the experiments I was mentioning before, we are still not sure that we fully understand the way the algorithm behave in our experiments. And so that, I think, is dangerous. That is, you delegate the decision-making to algorithm, and at the end, they do things that you are not sure to understand. So that could be a source of risk, especially because financial markets are very non-stationary. And in order to train the algorithm, you need a stationary world. So whether we can really apply the tools of reinforcement learning, for instance, in the context of financial markets, which are very non-stationary, I'm not sure. Another concern is that there is a risk of manipulation. Algos could learn to manipulate the market, but vice versa. Humans who understand the logic of the algo could generate, for instance, fake data or a type of data that could manipulate the algo during the training phase. So we are just at the very beginning, of understanding the economic implications for financial markets of those algorithms, and I think we need to be careful here.
A lot of challenges ahead. We have a question from Rome, Maurizio, who asks a very simple question. What implications does this AI revolution in finance have on the real economy?
So that's a very important question. At the end, the financial market is not a sideshow. That is, it is important for what happened in the real economy, for instance, for corporate decisions, for investment, corporate investment. And there is a connection. Let me come back to our finding that analysts, over the long run, they have become worse at predicting the long term. There might be many factors for that. I have mentioned the rise of alternative data. That's one factor, but certainly there are other factors. That might not be so good for corporate investment. That is, in some situations, firms have to make investment that will pay off only in the very long run. That's a real decision. Think about investment to cope with the climate transition, for instance. These are very important investments for society. These are investments which will pay only in the relatively long run. If the financial market has problems reflecting the value created by those investments because people forecasts are too short-termist, then maybe firms' incentive to realize, undertake those investments is going to be diminished. So thinking about the effect, of all this data, this great technology, artificial intelligence to mine the data, on the ability of the financial markets to make long-run forecasts about the value created by investment is very important. So that where there might be a connection between the impact, of those tools from artificial intelligence and big data on the quality of predictions made about future earnings, for instance, by people in the market, and the real world.
Thank you very much, Maurizio, for that very pertinent question. There's a question that comes in, I don't know exactly where from by Dr. Armin Pern, who describes himself as an AI evangelist and a sustainable food production enthusiast. And it's a bit of a technical one. He asks, Thierry, is it fair to say the model did not learn well how to price correctly, or has it been trained poorly?
Oh, I guess this is a question about my last example and my experimental study. I think this is a very good one. That's something we discussed, in our study. In a sense, in our case, we know that because we tried. One of the reasons why we don't get the competitive outcome that we were expecting is because we did not train the algorithm sufficiently. But when I say that, we did not train sufficiently, but still we have 1 million repetitions of the same environment for the algorithm to learn how to behave, and the task we ask the algorithm to perform is not very difficult. If we repeat more, that's great. I mean, it's true that the algorithm is going to learn better in our case. We observe that in the experiments. But still, that raises question because that means that in the context of financial market, to learn, you will have to experiment. That's the only way you can get feedback to train your algorithm. And during the training phase, if the training phase is very long, you take the risk potentially of losing money. So in real financial markets, that's something that people may not be able to afford. So I agree with you that the length of the training phase is very important, but the training phase is costly. Whether actors in financial markets can afford to pay the cost is unclear.
And well, we have time just for a final question, unfortunately, but I want to assure the viewers that Thierry will be happy to answer all the questions that remain unanswered or that come to you afterwards in a written form. Thierry, this comes from Paul in Washington, D.C., and he asks two questions that are linked. First of all, how important are the quants and the quant firms that you mentioned earlier?
Okay. That's a great question. The quant funds are still as a fraction of asset under management in the active asset management industry. They represent, that depends a little bit how you count, but there are studies on that, they represent about 8-10% of asset under management. So they are still relatively small compared to funds that produce their information in the traditional way. But the trend is positive. That is, we see more and more quant funds, and we tend to see fewer what I would call discretionary funds, that is, funds that produce their signal, their information in traditional way. So an interesting question is, are we going to see a point where we will have more quant funds than discretionary funds? I think this has to do to the question I was asking before. Is there still room? Are there still cases where human judgment is going to be better in terms of prediction than machine predictions? I'm completely unsure about that. We know that for cognitive reasons, human may not be very good at forecasting tasks in some situation. That being said, for instance, for long-run predictions, they might be better than machines because they might be better to understand completely new situation, maybe with economic reasoning or maybe based on strategic reasoning, than machine. Machine, they can only make decisions when they see something they have already seen in the past, in the sense. So to answer your question, there are more and more quant funds. That's the observation. Whether they will end up dominating the place, I don't know. That depends very much on whether there is still room for human judgment in forecasting and making decisions.
Well, I've just been told that we can extend by a few minutes this exchange, and that allows me to ask the question from Naufel, who's an executive MBA candidate for HEC Paris. Maybe we'll bump into him when he comes. And the question is, could the rapid decision-making of AI, that's an understatement, in high-frequency trading exacerbate market volatility or lead to flash crashes?
Yes, that's a very good question too. One way to use algorithm in financial market is to react super quickly to events, to news. We see that, for instance, when firms upload their corporate filings in the US, let's say 10Ks, on the SEC website, it has been observed that there are algorithms that immediately get access to the filing, read the filing with techniques from artificial intelligence, natural language processing techniques, and based on that are going to make a buy or sell decision over the very few seconds that follow the uploading of the filing on the SEC website. Is that good for price efficiency? On the one hand, yes, that accelerates the speed at which some information in the filing is going to get into the price. But of course, if you do very, very, very quick processing, there is the chance that you are going to react to noise. We know that in financial markets, for instance, there are fake news. And we know that algorithms react in some situation to those fake news. In fact, this has been one explanation proposed for those flash crashes events that I have mentioned before. So it's true that this is another risk, which is if you react too fast to information, because you have the technology to do so, you take the risk of reacting to noise rather than signal. If you take the time to think about the information a bit harder, check, for instance, the facts, then this risk is lower. So there is a trade-off. The problem in financial market is that the more you wait, the more your profit is going to be competed away by the people who move before you. So that creates a trade-off which is not in favor, again, of market robustness here.
So is there a discussion about safeguards to prevent this?
There are safeguards in financial markets, like circuit breakers, for instance, but not in this context, not that I know in this context.
Okay, well, another question comes from an independent financial services professional called Bruno Dupont, who is in France. Can you identify situations where AI would be better than humans at predicting the future? And he was thinking of climate change catastrophes.
Okay, that's an excellent question. So there are many studies, there is an increasing number of studies comparing forecast by humans to forecast by machines. I don't know the studies, across disciplines, but I know some of them in finance. So let me answer the question with the studies I know in finance. So there is one, for instance, that has been recently published in one of the leading research journals in finance that compares the forecast made by equity analysts at various horizons and the forecast made by machine learning algorithm, neural network, for instance. And what they find is that, in general, the machine learning algorithm is doing better than the human. But what it finds as well, which is very interesting, I think, is that if you combine the two, that is, if you give to the algorithm as a piece of information, you need to feed the algorithm with data. So you give to the algorithm as a data point analysis forecast, then the algorithm is going to be even better. So that suggests that there is something unique in human judgment here. That comes back, to my previous discussion. It seems that analysts, they are able to make predictions or to process information in a way that the machine cannot do. That's good news for the human, and that suggests that maybe the best model would be a model where, this is called the centaur model, or an hybrid model, where basically you combine what is unique for the human and what is unique for the machine.
Has echoes of 2001: A Space Odyssey in that debate.
As we know, that may end up badly, but...
It may. A final question, Thierry, comes from Toronto, Canada. So I was just looking at, I watch around 7:30 in the morning over there. Samantha Pierre asks a similar question. As we move towards AGI, perhaps you could tell the viewers what AGI is in a word? Because she asks specifically the idea of AI being able to program and train themselves. Yes. Do you see the same problem?
Yes, I think this is related to my last point about this shift in the way algorithms are designed, which is increasingly algorithms can learn by themselves how to make decisions. So you could even imagine that they learn by themselves how to be coded. I think there are many issues with that. One issue is that, again, it's very difficult to understand what they do at the end. That is, to regulate financial markets, for instance, you need to be able to trace the actions that led to an issue. If you cannot do that because we don't understand the way algorithms are reaching a decision, because the way this is done is a black box, essentially you feed the algorithm with tons of data. The algorithm is to learn a behavior with these tons of data, but it's not going to tell you why it does that in this situation, then you have a problem. So one risk is that because algorithms that learn by themselves are black box, essentially, it's going to be more difficult to regulate the behavior of those guys.
Thank you very much. And by the way, AGI is artificial general intelligence, and it's used to create programs that has intelligence that are similar to the one that humans are supposed to have and able to be self-teaching. I'd like to thank you very much, Professor Thierry Foucault. I don't know if you want to have a final word.
No, thank you, everybody. And if there are former alumni in the audience, then I say them hello.
Thank you very much, and do tune in next year for our next masterclass. Goodbye.
Bye.
Creativity is a social experience. You're not creative alone.
Despite its struggles, ESG can overcome the criticism and help make companies more accountable towards all stakeholders.
Today we're going to talk about things like trust and teams,
Bitcoin, blockchain, cryptocurrencies,